everybody. Welcome to TraderMerlin Show for your Tuesday edition. A special show today because I've got a guest on the program. You don't get to just hear me, talk and talk for an hour. You'll get to hear two people talk and talk for an hour. We will get into some of the bloodbath that happened out there today, specifically a lot of the commodities, which of course is going to be a big factor in today's discussion. Because joining me from the great state of Texas, talking about bonds, equities, currencies, and commodities, which we call affectionately the B.E.C.C report for July, we've got Scott McCormick, CMT, joining us. Scott, how you doing, my friend?
Any better than I couldn't stand it. How are you?
I am fantastic. I'm glad to have you on. I was under this goal to get you on once a month, but now it seems like it's become once every 2 months. But I'll take what I can get out of you. How you been?
I'm doing pretty good. Enjoying the summer so far, although it has been fairly warm here in Texas.
Yeah, we're going to change it to a triple-digit state, right? You got them 100-degree heat.
Yep.
One thing that's great about Texas, you get the extremes. Like out here in California, like if it gets into the 40s, it's a state of emergency. And maybe we get into 100 in the Southern California area. But with Texas, it's like in the wintertime, you're at negative 20. Wintertime, you're at 110. Or summertime, you're 110. I'll take the consistency. I don't know why you don't move to California.
In both scenarios, we get warnings from ERCOT saying you might have rolling blackouts.
Oh, nice. And the good news is you now have all of these Bitcoin miners, which are just eating up a ton of electricity on the grid. So congratulations.
Yep. Thank you, Governor.
Yep. You're welcome. All right, let's dive into our discussion today because I want to spend a lot of time on the third and fourth bullet point. But every month, for those that don't know, Scott spends a lot of time, actually every single day, he's analyzing each of these markets plus others. But these are the four majors, and that's bonds, equity markets, currencies, and commodities. Now, for those who watch this show, I've put a lot of emphasis in the most recent months on commodities and currency, specifically the dollar. Today, we'll dive a little bit deeper, but I want to start off by talking about the bond market. Have you seen anything significant change in the bond market that might give you clues as to where we may be headed going forward?
So what was really kind of interesting about the bond market, you and I, we've talked about this quite a bit, over the past few years. And, there was discussion about, on the 30-year at least, the interest rate getting up to about 3.46%. And it just so happened to get up to about 3.278%, just this past month. And so it's at an area of inflection, if you will, from November of 2018. That's where interest rates kind of topped out after a rally of about 18 months. Before making their decline down to those, March of 2020 lows. And so, with the area where we're at right now, it's going to be very interesting to see whether or not interest rates continue to march higher or if they actually manage to roll over here. So, with that, we're also at a pretty important demand area in bonds. I was looking at 139 to about 136 on the 30-year. It got down to about 131, but it's been basing around here for the last few months. So the question is what happens next? And one of the other things that I noticed in my analysis over the weekend was that the relative strength ratio between bonds and stocks has actually turned higher, which is interesting because both bonds and stocks have been going down over the past 6 months, but this shift in the relative strength performance between bonds and stocks is kind of indicative that we might actually start to see a little bit more strength come into the bond market here over the course of the next 6 to 9 months. So it's pretty important area where we're at right now, I think.
Does the inverted yield curve impact you? Because I'll bring up the chart here for everybody. I've been showing this one, and I know that the industry is generally saying that it's the 10 and the 2-year is the basis for that, and we are inverted as we speak. But also, if we look at the 10 versus the 1, here's the chart for everybody. The 10 versus the 1 was inverted. Actually, it just went back under it today. Does that concern you? I know we went inverted back in 2019 on the 10 and the 1. On the 10 and the 2, we did it just back in March or April. Is this concerning at all, or is it kind of like, whatever, it's inverted again?
It's not necessarily something that I watch. I know that it is an important gauge for a lot of institutional investors to really kind of give them a signal that, hey, maybe we are moving into a recession. And so, one of the things that I pay attention to kind of help me with that is just a traditional model that I had to study during the CMT program, in terms of asset class rotation and sector rotation to get an idea as to where we might be within that cycle. And, so if anything, the yield curve spread that you're referring there, the 2 and the 10-year might give that signal, but there's other things that I pay attention to that also kind of send those warning flares into the sky as well. Just not looking at the 210. So, at this point, what's kind of interesting about where we are right now is that, interest rates have been going up, bonds have been going down, and the thing is that bonds really topped out, at least on government treasuries back in the spring of 2020, and they've been on this decline since. And so in this market cycle that I had to study, one of the things that it just kind of foretells, if you will, or is not foretells, but is traditional with a regular market cycle is that, bonds generally top out before stocks typically top out before commodities, hence the B.E.C.C reports of bonds, equities, commodities, and currencies. Mm-hmm. And so, looking at where we are right now within the bond cycle, we've been going down now for, just over 2 years. Right. And so, if we actually do start to see bonds bottoming out, guess what? That's actually going to put us over into an earlier part of a recovery, potentially, or at least an early signal. And so, right. When I look at these things, going through my process, the B.E.C.C report, analyzing the higher time frame charts every month the way that I do, I'm trying to put all of the price action that I analyze into context within this market cycle, and then from there, I might get an idea as to what stage of the market cycle we're actually in, and then from there, I'll use the actual price action to confirm. So if you don't mind, I'll go ahead and share this the screen here.
I think we're all good with you sharing your screen. They probably are dying to see your screen. And a quick shout out to Oscar from Innsbruck, Austria. You get the distance award. And guys,
holy cow.
Yeah, and if it's late at night over there.
I was going to say what is it? It's not Guten Tag. Is it?
Yeah. Well, Guten Tag would be good day, but that's yeah.
Guten Nacht.
Guten Nacht. Yeah. Guten Abend. And if you guys have questions, feel free to type them into Scott. I'll be feeding those on to him. Just make sure you type a couple question marks. And it's good to see a skilled stocksman and so many others in the group today. I don't see your screen yet, Scott.
Yeah. It's saying that the host.
Yeah. It always does this. It drives me nuts. I never remember how to let everybody share their screen. So hold on one second. Oh. Sure. Greg, he wants to share more. There you go. I think now you should have it.
All right, here we go. All right, so you guys should be seeing a little market cycle here. So it's called the idealized business cycle for 6 stages of the business cycle.
Ooh.
Yeah, I know, fancy, right? So this was actually in Martin Pring's book that we had to study, and so the idea here is that there's these 6 stages within an economic cycle. Now, I think what's probably going to be important for your listeners to understand is that, when we look at an economic cycle like this, going from trough to trough, in measuring that periodicity, if you will, basically like how often that actually occurs, traditionally going up into the bear market lows there, 2009. Historically, since 1945, the average market cycle was about 4.5 years. But obviously, with the Fed policy the way that it's been over the past almost 2 decades, we've seen an exaggeration of this in terms of its length and duration. So when I go through and I take a look at the market cycle, basically, in all of my analysis, if I have a situation where bonds are trending up, stocks are trending up, commodities are trending up, well, that's going to put me in stage 3. But if I have a situation where stocks and commodities are trending up, but bonds are going down, that's going to put me in stage 4, and et cetera. So it's a pretty easy concept. But the point that I was trying to make here is that if I see, for instance, that we're in stage 4 and I expect stocks to start declining, well, I need to look at some key lows where, if broken, that would be the signal that, hey, okay, yes, we're moving into stage 5, say 5, And from there, looking for some of the key areas here within commodities to say, well, maybe we're now moving into stage 6, right? And it doesn't always pan out this way. If you were to go back to the market lows in 2002, October 2002, March 2003, commodities actually bottomed before stocks did.
Mm-hmm.
And so a lot of that, of course, also has to do with the dollar, the strength and the weakness in the dollar. Strong dollar would actually be pretty bad for commodities, whereas a weak dollar would actually be more beneficial for commodities.
Mm-hmm.
So going back here, I'll pull up my chart.
Actually,
so,
before you, well, I was going to say, before you switch
ahead.
up, no, it's all good. I just, obviously I might be jumping the gun here, but, if I look at this stage in cycles here, right now you've had 2 years of bonds selling off, so stage 4 is check. Stage 5, you've got
Right.
stocks have been selling off for the better part of 6-8
January.
months, and commodities for the past 2 months have not only been selling off, but screaming down. I mean, they look like cryptocurrencies right now. They're moving so fast. So, it kind of lines up where this business cycle is headed for a big down move, and I think we're in the midst of that right now.
Yeah, and so if you do have that situation where all three of these have been trending down, then the next thing that I would start looking for is do bonds actually start to bottom out? And so
Right.
when they talk about bonds here, keep in mind that they're talking about bond prices, not interest rates. And
Right.
so there's that inverse relationship there. So if bonds are going up, interest rates are going down. If bonds are going down, interest rates should be going up. And just to kind of put that into perspective here. And forgive me for how small some of the font might actually be, but in the upper left-hand corner here, what you have is the 30-year bond. This is your continuous contract, and this is a chart going back into 2002. And so whenever I map this out, I'm looking at the longer-term trends. I'm looking at whether we're in an impulse or a corrective phase. And so obviously over the past 22 years, we've been in this long-term uptrend, which, back in May of this year actually got broken. And then from here, you're also going to notice that we've been trading in and around two areas of demand here. So this was the one that I was talking about a little bit ago, and around that 139 area, we kind of poked through that. And the market itself has now kind of come back down to this other area here, and has really kind of just been basing around for the past 3 months. And so when I see something like this, if I were to look at this diagram and say, okay, well, based on all the price action, I think we're in stage 4. So if everything is a cycle, or not stage 4, stage 6, because that's how you read Roman numerals.
Uh-huh. You're dyslexic with Roman numerals. That's okay.
Right. So if we're in stage 6 here, then what's the next stage? Next stage would be stage 1. So what are the things that I would look for? I would start looking for bond prices to go up. And then what would I look for next? I would look for stock prices to start going back up. And so what would that look like? Well, coming out here and looking at the 30-year bond market, I would look at the fact that, 1, I'm at a demand zone. 2, I would expect prices on lower time frames to actually start to reverse. So if I were to pay close attention to where we are here, this swing high from back in May is going to be a pretty critical spot in around that 142, 144 area. Because if we do start to see that we get some monthly closing out above that, then that's going to indicate to me that the overall trend has reversed, in which case I would actually start becoming bullish on bonds.
Mm-hmm.
And then eventually, that whole cycle kind of, or that whole process repeats on the stock side as well. And one of the other things about where we are right now in the bond market, because this is something that you and I talk about all the time, we've had this super long-term downtrend in interest rates. This is a chart going back to 1977-ish.
Yeah, crazy.
But and this is why I say all the time, put things into perspective. Because for all of those that are out there, they're looking at interest rates which have gone from sub 1% to now 3.1%, and they're freaking out about how high the interest rates are. I'm like, you have no idea,
Yeah.
right? How bad this actually was back in the late 70s and early 80s. Not that I had a mortgage at that point in time, but
I know my parents did. I think that the challenge here is, everyone's saying, well, the rates are going to get back to a normal level, right? They're going to normalize. And I think you look at this 30-year Treasury bond, okay, that might give us some clue as what normalization might look like. But, we don't know what normal is, right? Is normal 8%? Is it 10? Is it 6? Is it 5? I mean, we're going to have to let the market figure that one out. But I think being below 1% is just absolutely ridiculous.
Yeah, and it is. And when we take a look here, kind of going back, and this is just, straight up old school technical analysis, old support, new resistance. You take a look at where that interest rate was, at 7.1%. Now, of course, borrowing costs being higher, what they are, maybe we're not going to see, the type of asset appreciation or I shouldn't say asset appreciation, but the type of participation in the real estate market that a lot of individuals have had over the past 20 years because of lower interest rates. But so there are major implications there. But setting all of that aside and just looking at the data, looking at where we are right now, we're back to this inflection point from November of 2018. And we literally just kind of came right back up to that area. And the question is what do we do now?
Right.
Because if we do manage to actually get through, and I would actually go so far as saying if we get north of that 3.5 to let's say 4% on the 30-year bond, then I think that would be a pretty major shot across the bow of interest rates. But taking a look at where we are right now, one of the things that I always do is I like to map out my measured moves and so forth and just kind of see like where some of my targets would be. And so in this particular case, there was a target in around that 3.3%. And the next one would be here at about 3.8, which is sitting inside of this area here. So, this is why I think that, again, we're in a pretty critical inflection in terms of bonds. So if bonds do turn up, then I would expect that interest rates would start to turn lower. So if I were to kind of go through this, the thing that would kind of give me some sort of confirmation, at least on the short term, that interest rates are turning down, that would be if we see, interest rates kind of getting down below that 2.9%, on the 30-year bond. And of course, you start to look at the 10-year and where we are, both in price and interest rate. I mean, it's pretty similar here. And how we came down to this area of demand, just kind of basing around, poke through that. And we're trading in and around areas from 2009. But when you look at the interest rates here, you can see that, again, we're pretty much doing the same thing with the 10-year interest rate as what we did with the 30. But it did poke up here a little bit higher, kind of like what we were just talking about on the 30-year. So question is do we get down below that 2.7% on the 10-year? Because if we do, then again, and it's I don't want to say crisis averted, but that would just be one of the things that would give me a sign that okay, maybe we're starting to see some turns here.
Yeah, let me ask you this: what, from your perspective, do you think might be the catalyst for that to happen? So I'm looking at it from the perspective of I've got the Fed basically unwinding their balance sheets of mortgage-backed securities and treasuries, so they got to sell this, or flooding the market with it in order to entice someone to buy this garbage that they've loaded up on, been pretty much a monopolistic buyer of 10-year of government bonds. They're going to have to offer a higher yield. So I look at the 10-year, which I'll bring up the weekly here. Here is the 10-year bond yield, and you guys can see it's been surging and surging. We got hit that 3.5, just about 3.5 mark a couple of weeks ago. What do you think would be the catalyst to push these yields down? Because in my mind, it feels like they're going to keep going up. So what am I missing? Hello?
Sorry about that. It helps if I unmute.
It's okay. I thought I lost the call. I was like, no, not Scott.
No, not now. I was having this conversation yesterday during one of our XLTs. Because when I analyze the market, I focus solely on price.
Right.
I don't spend a lot of time thinking about what the next catalyst might be. Not because that's not a valuable, investment of my time. It's just, what if I'm wrong?
Right.
It's like I don't want to develop a bias as to, well, X, Y, and Z has to happen, because if it never happens and the prices start to go in the direction that I thought they were going to go, or not. If they
Yeah.
just start to do something counter to what I thought that they were going to do, then then what? So my whole approach is look at the markets, look at the price, let it tell you, where you are, and kind of set up the expectation as to what should happen next, right? So kind of going back to that market cycle again, if we are in stage 6, then yeah, bond prices should continue to go lower. So what do I solve for? Kind of thinking of it in terms of a math equation. Solve for X. Okay, so I would look for other areas of demand where bond prices might continue to go down to. I might look for other areas where some key inflection points where interest rates might go up to. But then if you do start to look at it from a macro perspective, okay, and not just macro, but maybe even global, okay. We are at a place right now where treasuries, are trading at some of the lowest prices in the last 2 years. Interest rates are at some of the highest prices in the last 2 years, actually almost the last 4 years.
Yep.
So why wouldn't someone actually look to buy these bonds, which also could be part of the reason why we've actually seen the dollar go up as much as it has, because you have foreign countries coming in to actually buy these bonds at higher interest rates than what they can get in their home nations.
Right. Yeah. Right? Print money in my country that's making nothing, and then buy bonds that are paying me, 2-3%. So that I get that. I just throwing it out there.
Yeah, and it, it's like to a lot of listeners, they might look at that and be like 2 to 3%. That's not that big of a deal. Well, you start to think about 2 or 3%, or let's even say. Let's say that the delta between one country's bonds and another is 0.5% or 0.75% or maybe even 1%. Right? That doesn't really sound like that big of a deal to a lot of people. But when you start to talk in terms of billions of dollars,
trillions,
it adds up.
Yeah, absolutely. Margaret asks, which bond is the most reliable for you as far as signaling? Do you have a preference as far as which bond product you'd be looking at for kind of signaling for market direction?
So you'll notice that I look at both the 10 and the 30 year.
Yep.
Okay. And if you get into bond theory, okay, and Bill Addis would be able to explain this a heck of a lot better than I can. But when you start to think about, the Federal Reserve and the changes in the interest rates and so forth, what I would say is think of it in terms of a bullwhip, okay? And what I mean by that is that if you were to flick your wrist, the part of the whip that is closest to your hand is going to move the least, but the part that's furthest away is going to move the most. And so when you start to think in terms of duration, for bonds, you obviously have your T-bills that are down around 90 days. You've got your overnight, I should say, your Fed funds rate, and you got your T-bills, and then you start to get out to your short-term maturities, your 2 years, your 5 years, and then you get into your 10 years and your 30 years. And so in terms of sensitivity to interest rate changes, the 30 year is going to be the most sensitive, whereas the 10 year would be kind of second most, if you will. Mm-hmm. Okay. Now, here's the other part. Okay, going back to your yield curve scenario here. Let's say, for instance, that the Federal Reserve sees over the course of the next 2 quarters, which 6 months, it's not that long, right?
Nope. Yep.
Let's say that inflation doesn't necessarily top out, but the rate of change is slowing down. They might decide that, instead of cranking the interest rates a 0.5 point or 50 basis points every meeting, or whatever they've previously committed to, if they say, we're looking at this and we think we can get away with 1/4. Well, what does that indicate? Okay, it indicates that they are becoming less hawkish, and I don't want to say more dovish, meaning that that it's a more accommodative monetary policy, but from an interest rate changing standpoint, when the Federal Reserve is increasing interest rates, what you want to try to do is stay on the shorter end of that curve until they get to a point to where they stop raising the interest rates or they indicate that they're slowing down, and then you move out to the longer part of the curve. And the reason why is because if they're in that raising interest rate environment, let's say that they're in this process of raising the interest rates over the course of 6, 12, 18, 24 months, if you're a shorter maturity, you have the ability to hold that bond, let it go to maturity, and then go over into the next higher interest rate. And then once you see that, you know what, Fed monetary policy here, it's starting to kind of wane. They're not being as hawkish as they were. They're not raising the interest rates. Now you've got the interest rates on the 10-year that lock in at 100 basis points higher than where you could a year ago. So that's a full percentage point.
Right.
And if you're holding that bond for 10 years, you know, that might not sound super wonderful, but you know, compared to most other situations, especially 10 years ago, it can be a benefit, right?
Yeah. Well, it's like if I'm getting bond market alpha, you know, I can buy it and get 3%, but all of a sudden in the next 5-10 years it drops all the way down to 2%. Well, I'm making alpha.
Exactly. And you know, and as those interest rates go down, your bond prices are going up because your bonds have a higher yield to them than what is currently available in the marketplace.
Yeah, yeah.
So, and it's sorry to get all academic there, but
it's okay. We like it. Nerd out, buddy. Nerd out.
But yeah. So to answer that question though, you know, I pay attention to the 30 and the 10-year most.
Okay. I'm going to move quick because I've just realized we spent 26 minutes and we haven't even gotten to the E, which is equities yet. So we got to move it. With regards to the equity markets, obviously we've seen some tremendous swings going on. A lot of people overly bearish, which is now all of a sudden making me somewhat bullish in the short term, just because everyone thinks we're crashing. Here is the weekly of the S&P 500 for the viewers out at home. Still looks like a great downtrend from those peaks we saw back in November and December of last year. But if I bring it onto a daily, you know, there is some technical patterns here. You can see we're starting to make some higher lows. We'll see what happens the remainder of this week because we've had 2 good days of sell-off. But what's your kind of high-level view of what's going on in the equity markets?
So you know, when I go through this process, I'm always looking at the monthly charts, right? Because that, to me, that's the great filter. And when I'm looking at the monthly charts, what I see right now is that, you know, the long-term trend, okay, and I'm going back to the lows in 2009 to where we are today, it's still up.
Yep.
And the trading that we've seen basically since the highs there in January is corrective in nature. And so when I look at the markets, there's a couple of things that I want to know, which is what's the trend and what's the phase. And so if I know that the trend is up and we're in a corrective phase, what that's going to tell me is that maybe I shouldn't be overly bearish from a longer term perspective. What I should be doing is being patient, letting the market go down to more attractive areas in terms of value, and then start to look for the price action on that lower time frame chart, like the daily chart, to see if we actually get terminations and reversals of the trend and looking for some buying opportunities. One of the other things that I like to do is of course measured moves. And so, you know, I'll measure out the impulse moves to see how far the market can go up, how far the market can go down. I'll measure the prior corrective moves. And so, you know, measuring that decline from the highs there in February of 2020 down to the lows in March of 2020, which was the last technical correction that we had on the monthly chart. That forecast, if you project that move from the highs there in January, February, should I share my screen?
Oh, that'd be great because I'm just drawing along over here.
Yeah, so let me share my screen again.
Sure, no problem.
Quick. So this is the correction that I was talking about right here.
Okay.
And you know,
the COVID crash, yeah,
the COVID crash, and again, when I look at the charts, you know, I'm going back, right? I mean, like I'll go back as far as I can, so I can see what the longer term market cycles look like, you know, and where we are, of course, in the short term as well, but. You know, again, the price action here from the highs in January down to these lows obviously are corrective. And so just measuring from that high down to that low and then just taking that and kind of projecting that from the high that we see here, you can see that it actually forecasts to target in around 36.28. And it just so happens that the low that we had here was 36.36.
I'll take it. Close enough for government work.
Right, and so kind of going back to what I was talking about in bonds, which is, you know, if I'm at an area of demand and I see that I've got this measured move here, then what am I going to start looking for? You know, I'm going to start looking for those reversals on the daily chart to indicate that that trend is actually terminating. And so, and keep in mind too, for all of those listeners that are out there, if you're looking at my chart, I'm using the SPX.X on TradeStation, which is the cash index. I don't like to do this on futures or the ETF because I get more historical information. It's more accurate. You don't have contract rollover. But 4177 and a half here, let's just call it 4178. That's going to be a pretty key area.
Yeah.
So if we manage to get a monthly close above that, that would tell me that, you know what, from a longer term perspective, we're probably seeing a shift. And the reason why that would be important is, again, kind of going back to where we are here. You know, if bonds bottom out, what should I be looking for next? I should be looking for stocks to bottom out and turn higher. Now, it's not to say that bonds can't continue to go down, but kind of going, or not just bonds, but also stocks, they can continue to go down, obviously. But if some of the things that have been kind of weighing on the market, such as supply chain issues, inflation, high commodity prices, et cetera, which is inflationary, if those start to wane, then those kind of headline risks are out of the way.
Yeah. Yep.
The question then becomes, is there still demand from the consumer side? And I think over the course of the next two earnings seasons, which, the first, this next earnings season is going to start on Thursday. And, we start to see and get a measure of the consumer and how a lot of those consumer discretionary and consumer staple stocks, how their earnings have actually panned out over the course of this past quarter. And of course, going forward, so, if you're really paying attention to it, I would start paying attention to what the forecasts are from the CEO, what type of language they're using. Are they still pretty cautious? Are they cautiously optimistic?
Right. Yeah.
Are they what are they talking about in terms of the supply chain issues? Are they starting to ease up? Are they still persistent? So
on your charts here, first off, I'm surprised, like that SPX.X chart, that chart gives me anxiety. You have so many fib extensions and retracement lines on there. I'm like, I can't even focus on it right now. I'm looking away. I'm staring at the other wall. Yeah. Good question from Doug. He says, how much do you depend on those Fibonacci? Are you just using them as an educational tool, or they mean something to you?
So they do mean something to me. I don't, I was having this conversation yesterday in the XLT, the stock XLT. I don't really rely much on the Fibonacci retracements. I look more so at the Fibonacci extensions. And, even though I have the different ratios that are on here, the first thing that I'm always going to is 100%.
Right.
Okay. In terms of like measurements, because if the market can go beyond that, then that tells me that it's a stronger market. In which case, I'm going to start looking for the other targets like the 127.2, the 141.2, the 161.8, the 200, 261.8, et cetera. So as I'm looking at this, for instance, if you come back here, like this area right up and around right here, we were looking at. Let me see if I can actually delete some of these. I'm a little nervous because I don't know where all of these are coming from. But, we had this initial impulsive move here from the lows in March of 2020 going to the highs there of September of 2020. And then when you project that from the lows, okay, from here, you can see that the 100% extension was here at 4605, the 120 or the 112.7 was sitting here at 4781. And, when we get up and around those areas, the market is kind of slowing down, so if I'm looking at this and I say, okay, well, the market's been trending up, I see the bond market going down. What are some key areas here for the S&P 500? If we crack 4278, that's probably going to tell me, for instance, that, we're moving from a stage 4 into a stage 5.
Okay.
All follow me?
Yep.
So if I'm now looking at, where we are here, and again, I'm just going to clean up some of these, but, looking at the corrective phase and where we are, just measuring that, projecting that from this high, which took place back in January, 100% extension is sitting right here at 3619, and so when I have situations where market gets within that distance, I mean, that's pretty close, right? So, am I gonna stress out? It's like, nope, the market's got another 20 points to go. No, dude.
It's a range.
Yeah, it's a range. It's just a way to say, you know what, we've gotten pretty close here. So if I start to see that the market is reversing, then I'm going to start looking for some buying opportunities. But the other part of that is also true in that if we get beyond that, where's my next targets? I'm going to look for 112, 127, et cetera. But I'm also going to be looking for those areas that also line up with other areas of demand within the S&P in this case. And so when you do that, taking a look at where we are right now, if we do go beyond that, where's the next target? It's 112. We've got a demand zone that's sitting here at 3507. So even if we do break down, that's not that big of a move from where we are right now.
Yeah, it's
right?
less than 10%.
Like 300 points. Yeah, it's a little less than 10%. So that would be a reasonable assessment. And then, of course, you've got the 127, which is also in there. But then you go beyond that, yeah, now you're in trouble, because you start to look at where some of the other areas are. I mean, there would be a target down here at 2124, and that would just really kind of coincide with a huge problem.
I've got the same one down there. I'm optimistic. Let's get back to those pre-COVID lows. It's funny because people are freaking out about that, like, we could never get that low. It's like you realize that was only 2 years ago.
Yeah.
It's not like it was 70 years ago and we've never seen them. It's so recent. It's unbelievable. Yeah. So, all right, that was the equity side of things. Currencies. So we've had the U.S. dollar on an absolute just ripper of an uptrend. It keeps trending stronger and stronger. You had a great call, and I stand by you. I think you're probably right. If not, you might have shortchanged yourself, saying a USD JPY getting to 150. As far as a carry trade goes, for anybody who knows spot forex, carry trade is you're holding one currency and selling the other in an attempt to collect the interest. The dollar gets more and more attractive every time that they keep raising the Fed funds rate and yield increases. So give me your take on the dollar index and what that might mean for some of the other things. And lastly, do we see the British pound at parity?
I don't know, but if we do, then I'll probably finally take my trip there.
I'll join you. Yeah. Let's do it.
So I'm going around all of the islands, by the way. So when we take a look at where the dollar is here right now, and I'll clean up some of this here to really kind of help you guys out and see this. So this is a chart basically going here to the lows in 2008. And when we take a look at this, you can see that the larger structure here of the dollar has been in this longer term uptrend. And so I'll throw in my other swings here to help illustrate that. But we were in this very wide sideways range for a couple of years. Actually, this is, when I say a couple of years, quite a bit. It's going back to, let's say, December 2016, January 2017, and when we bottomed out about 4 years later. So as we're taking a look at where we are right now, the fact that we've actually broken out of this range is pretty positive. Yeah. So there's a couple of things here in terms of technical analysis and doing measured moves. When you see a range like this, one of the ways of measuring that is just to literally measure the height of that and then just project that from the point of that breakout. So wherever that peak is. And you can see that gives us a target up here in around 119 for the dollar index. So we're at 108 right now, which suggests that we could see a continuation here, which would obviously be very bearish for the Japanese yen, the British pound, and the euro, because all three of those are the top three currencies. And actually in order, it's the euro, the Japanese yen, and then the British pound. Those three make up 87% of the dollar index. And so if those continue to decline, then the dollar index is going to continue to move higher. And to your point, Fed continues to raise the interest rates, it's just going to make this more attractive and the others less attractive. The other thing too, if you notice here, I have a measured move from the swing lows there in 2011 to the highs there in 2017, and then projecting that from the lows here in 2018. That gives us a target here of 100% at 119, which just so happens to coincide with the measure move of that range breakout. And the fact that also coincides with an area of supply there at 116 to 120 gives me a pretty high area of confluence in terms of how far the dollar could go. Now, I was talking about this morning. There is an area of supply here at about that 106 to 109 area. But even if we do see the dollar kind of pull back from there, that wouldn't necessarily terminate and reverse this longer term trend. And so one of the things that I would watch for is, just retracements back to some of these prior swing areas. And so, we've got an area of demand in and around that 104 area. We're going to have another one down here at 102. And as we take a look at where we are right now, in order to actually terminate and reverse this daily uptrend, we would actually need to see the dollar get down below 101 for that to actually happen. And that's pretty far off, right? So we could have a reaction here, see that market kind of pull back down to where it broke out from. Obviously, here in the monthly chart, you've got a little rally-based rally that is just kind of hanging out. And from there, it's just a matter of what happens next. Now, if we really do kind of break down below that, then we might just get back inside of this range, in which case, dollar back down around 90 cents.
Which I think the markets would like that, actually, because this surging dollar is really starting to crimp the equity markets. We just hit parity on that euro, which you brought up right there, which I was pretty excited to see. Obviously, I'm planning a trip to Europe later this year. The one that everyone keeps asking me about, since now parity's off the table with the euro, is that British pound. From all the charts that I've seen, we've never been at parity against the British pound. Even going, I think the last time was in 1985. We were at 1.05.
That was a long time ago.
I mean, I don't remember it. I just was digging through charts trying to find it. There it is, way back there in 1985. How logical of a target do you think that is? I mean, is that just crazy to think we get down to parity?
Not necessarily. So, and again, looking at this, and I'll just kind of take your viewers through this pretty quickly. So, we have this major impulsive move here, corrective phase. You've got another major impulsive move here. All of this price action, believe it or not, from, whatever those highs were here in 2018 to where we are today, technically is all corrective in nature. And the reason why that would be important is because if we are back into an impulsive phase, and we know the last impulse that we had was back in 2014, 2015, down to these lows here, if we project that from where it topped out back in 2018, and we look at where it is that it forecasts the move to, we're looking at the British pound down around 90 cents.
Whew, man,
versus the dollar.
I'll buy you a pint.
You're going to buy me 10 pints.
No problem. I will gladly do that, my friend. Wow.
And we're going to go to the oldest pub in the UK that's still standing.
Well, if it keeps dropping that much, we may buy the pub.
True. Yeah, we'll just call it Yanks.
There you go. Oh, wow. Nobody will go to that bar. Cool. Well, yeah, I love it. Who knows? That's all speculation at this point, but
right. And that's the thing. I think that's really important for anybody that's ever operating in the markets. It's like I can put all these lines on the charts all day long, but it doesn't mean that it's going to do that, right? Pay attention to the price action. What would be a key event here for us to conclude that we're more likely to continue to the downside? Well, the British pound versus the dollar right now, it needs to get down below these lows from 2016 at 117.39. Now, we had this spot right here back in 2020. I wouldn't necessarily put a lot of emphasis on that because, that's we actually closed much higher. So I tend to pay attention to, where were those lowest closes and where was the low on that. So getting beyond this 117.39 with a monthly close, that would really kind of give me that signal that, hey, we're probably moving lower here.
All right, cool. All right, so we've gone through almost all of them. We've got bonds, we've talked equities, we talked currencies, and now the one that I've actually wanted to spend the most time on, but I don't think we're going to be able to do that, just from time permitting, is commodities. We hear so much about inflation on this show. I've talked about it a lot in the past couple of weeks. We hear about these CPI numbers coming out this week and PPI coming out, and everyone's saying 1.1 inflation is going to be so high, we're going to have almost 9%, yada, yada, yada. But the commodity prices have plummeted. You can probably run through some of those, but corn, wheat, soybean, natural gas, crude oil down 8% today. I mean, the list goes on and on and on. At what point does this inevitably have an impact on the inflation numbers, or does it? Am I just seeing things wrong?
No. So here's, I'm a huge chart guy, obviously. When you take a look at historical price action, I think it really tends to put things in a perspective because as humans, we tend to forget pain pretty easily. At the moment, it's horrible, but we forget about it. All of those that are complaining about like the $5 or for you out in California, $7 a gallon gas, they don't remember 2008, right? And maybe a large segment of the population, they weren't a driving age in 2008, right? So mom and dad saw it, but they didn't, not until now. And so when we start to take a look at things such as soybeans, for instance, right? Now this is a continuous chart. It's not it's not a custom continuous chart like some of the others. But now soybeans actually did break out and make new highs there in 2021. But when you take a look at it, what's it been doing? I mean, it's been going up since 2020, right?
Yep.
And so should we be surprised about inflation when we see food prices going up? Soybeans goes into a lot of stuff that we consume. Here, this is wheat. Now, what was really kind of interesting about wheat, if you just take a look at this here, you'll notice that wheat came back up to this area of supply here in around that 13.15 to 14.18 area. And so far, we've been backing off pretty quickly over the past couple of months. The question is what happens when we get to this area here at that 769? Because if we do break that, your longer term price trend on wheat is down. And I know somebody's looking at this chart right now. They're like, how in the heck is that a downtrend? Well, remember, I'm looking at longer term cycles here within these items. So I'm going back as far as I can on my charts to really kind of determine where it is that those critical swing highs and swing lows are. And I apologize for going so slow here.
No, it's tough to do this and talk at the same time. So we appreciate it. I feel your pain.
Yep. So, when we're taking a look at longer term charts, right? My suggestion here is that if you don't do this, you should, even if you don't trade these time frames, right? Mm-hmm. Because, for all of those that are just kind of like in shock about inflation, well, if you saw that commodity prices started to turn up like considerably going back into 2020, why would you be so shocked about it, right? Not to mention the fact that certain trading strategies, you can actually hedge your inflation by being long on some of these commodities as they're going up, Right. But the critical swing low here for wheat is actually right here. That's going to be 657 on wheat. But if we break down below that area, your longer term cycle here, it's pretty negative. Because if we do break down below that, that's going to indicate that this uptrend has been terminated. And because this upward move since the lows in 2019 is shorter than the downward moves from 2008, that's going to indicate that we're in a much larger secular bear market. And man, that's negative. So
yeah, I don't think we're going to see. I know. Yeah, exactly. I remember crude oil hit negative $40 a barrel. I don't think you're going to see wheat at negative $5 a bushel.
No, probably not.
You can have Bruce Jenner. I mean, whoever the Jenner is now, throwing out boxes of Wheaties for free.
Right, but you start to rip through and taking a look at any of these commodity charts, and you'll notice that a lot of these have come back to major areas of supply within the market. So. And looking at where the origin of these moves are, it's very possible that we can still get back down to where those moves actually started. So for corn, probably looking at it around that 189 to 94 area, going back to wheat and just kind of taking a look at where that really took off. Wouldn't be surprised to see if it did get down around that 679. So a lot of these commodity prices coming down, they should start to kind of make their way into the producer side of things. So I know we pay close attention to the PPI or the CPI, which is the consumer side, but it's also going to be the PPI that's going to be very important because on the producer price index, what is really important to watch there is if we start to see that the producer price index is topping out and coming down, eventually that should have a positive impact on the CPI, because if the costs for those goods is coming down, as a producer, I should be able to reduce my cost and with that kind of pass those savings on to my consumer, unless I'm being a greedy corporation and I want to keep my profit margins much higher.
Unless I live in a capitalistic society and I'm already getting $10 for my product, and why bother dropping it down? And I think that's the interesting part here, Scott, is it really is going to come down the road. We'll see if some companies are like, I always use the example of the Habit Burger down the street, which I go to on, usually on a Friday.
I love that place, dude.
It used to be $8. Now it's 11 something. And I keep seeing it tick up. It's like every week it goes up like another 5 or 10 cents. I don't think I'm ever going to see them go, you know what, let's bring it back to $8. You know, so there's some things I don't think you'll ever see go back down. Something like oil, yeah, I do think you'll see some fluctuations, but I guess time will tell what ultimately gets brought back down in price. But boy, you know, looking at things like natural gas down 44% in the past 2 months, and corn and wheat and soybeans, I mean, it's really spectacular seeing how much they've sold off in the past couple of months.
So you bring up an interesting topic there, right? So, you know, even if, let's say, for instance, commodity prices do come down and the cost for goods actually declines, but the corporation wants to keep the same profit margins, you know, that's one thing. But one of the other items is that if they do that, if they have that decrease in cost of goods, then there's that possibility that they can actually increase wages, which would make the consumer, or put the consumer in a position to where they can better handle those higher prices, you know, because, you know, if you were to go back and look at the price of sugar and wheat and corn back in the 70s, I mean, we're not paying, you know, the same price for sugar today as we were in the 70s. We're not paying $1 a gallon of gas like we did back in the early 90s, you know, so some things they just don't go back down.
Right.
But it's because the cost of other items have continued to increase as well. So,
and we'll have to keep our eyes on that data because, you know, if I'm a CEO of especially a publicly traded company, you know, obviously my main concern is shareholder value and making sure that my stockholders are going to get as much rate of return. So if I'm, you know, let's say I'm a cereal producer and wheat drops 50%, and I've already raised my price for a box of cereal from $3 to $6, I'm not going to drop it because people are still buying my cereal at $6, and I'm not going to raise the price, pay my employees more because they've got jobs. So, you know, maybe a little bit more, but, you know, I can't help but to think that maybe not this quarter, maybe not next quarter, but maybe getting into Q1, Q2, Q3 of next year, that some of these earnings, especially for commodity-dependent companies, might really start to see a pop.
Yep. Watch the consumer staples.
You've got a lot of fanfare here. People loving your stuff. So I'll give you a chance to talk about what I know you do. GPS sessions, and you do a bunch of other stuff for OTA. So tell me a little bit about what your schedule might be like, so some of these viewers that are OTA members can join you, and if those who are new, they can find you.
Yeah, so if you're a member of the Mastermind community, Monday through Friday, I am kind of the one of the co-hosts. I kick off the program called the Guided Pathway session early in the morning, and I don't necessarily go through all of the detail that I've gone through with you here today, but you know, I give the high level stuff on like the daily and the 4-hour charts to help follow those kind of intermediate to short-term trends within all of these markets that we've talked about. And then, you know, we pass the microphone off to the second instructor who spends time going through kind of shorter term intraday and swing trade type setups. You know, on Fridays, we give access to our XLT students to those sessions. And then every Monday, unless it's a holiday of some sort, I am hosting the stock portfolio XLT on Monday afternoon. So looking at the markets from a longer term perspective, looking for longer term setups. So, you know, not trades that would potentially last for days, but more so months, quarters. And, you know, if the equity markets keep going the way that they are, we're going to have a lot of opportunity.
Yeah, absolutely. Well, Scott, thank you so much for joining us. I literally could make this a 2-hour show to have you on. You and I both love talking about this stuff, and I know we'll get a bunch of more questions. But let's keep it at under an hour for today's session. Again, glad you're feeling better. Thanks for spending an hour of your time with our viewers, and I really appreciate it, man. Thank you.
All right. Thanks for having me. You guys take care.
Yeah, that was Scott McCormick of Online Trading Academy. You can find him, as he mentioned, in a bunch of different places. You have him in the XLT stock portfolio. That's on Mondays. He's also Monday through Friday doing the GPS, which is Guided Pathway Sessions, where he covers a lot of these details we covered here. But I think, and I gather that from a lot of your chats, what you notice right away is he's one smart dude. And it's what I like about Scott and his approach is It's an unemotional approach. It's just saying, this is doing this, this is doing this, this is doing this. And if this does that, then I'm going to make these types of trades. If this is doing that, I'll make these types of trades. So I think that's an important lesson, besides all the amazing content he just gave us, is just understanding that approach is just completely unemotional. You kind of heard where he's like, I'm not trying to forecast how this is impacting this and this and this. It's basically saying, let me look at bonds, equities, currencies, commodities, and those four things should guide my trading decisions. And I'll look at the price charts to help figure out which direction that's going to be in. Obviously, going in the direction of the prevailing trend is the best way to go. So hope you guys enjoyed that one. All right, I'm going to wrap it up here because I'm quickly screaming towards a 1-hour show. Again, if you want to know more information about anything that Scott was talking about, you can find out more information at Online Trading Academy. Just go to tradingacademy.com, and there you go. Let's see, I did not bring up the economic calendar and stuff for tomorrow because I was scrambling to get stuff done. As far as tomorrow goes, the only thing you have tonight is you're going to have New Zealand with their rate announcement happening right after later tonight. I think it's at 10 o'clock tonight. It's 7 o'clock tonight Pacific, 10 o'clock Eastern Standard Time is when we get the announcement from New Zealand, and they're going to raise 50 basis points as the expectation. We'll see how that comes in line. Now, for tomorrow, this is probably the most important piece. The previous CPI number was 1%, all right, month-over-month gain 1%, which is not very good. The expectation right now is it's coming out at 1.1%, so keep your eye on that one. That's going to happen. Let's see, that's 1 hour before the markets open tomorrow morning. That is the biggest piece out there. You also have Canada coming out with a rate announcement. They're expected to raise 75 basis points. So all of a sudden, you're seeing more and more and more heavy increases in the Fed funds rate. You saw it for Australia. You saw it for New Zealand. You're seeing it for the UK, for Canada, for the US. Strangely, you're not seeing. You're also seeing it for the Swiss franc, but you're not seeing it for the euro yet, and you're not seeing it for Japan. And we'll talk maybe down the road when it gets closer. The euro, their inflation number is growing even faster than the U.S. market's inflation rate, and they're doing nothing to control it through raising rates. So that'll be a very interesting thing to see what happens going forward. So that's pretty much it from your economic announcements. Earnings-wise, nothing really to speak of. It's all about Thursday when we start the Wells Fargo and JP Morgan, I believe, are the two that come out on Thursday. We'll talk more about that on tomorrow's show. I do have a couple listener questions that I need to get to on tomorrow's show, so I'm going to kind of build the show around a couple listener questions that came in. As Chase says, yeah, smash that like button if you like today's show. You can also send me comments and questions at any YouTube video on TraderMerlin. Just go underneath that one and whatever video you liked, watched, and give the comments in there. Or you can email me at TraderMerlin@gmail.com, which is on your screen today. When does Bill Addis join me again? I don't know. I'll have to reach out to Bill. I was kind of looking forward to having him on once a month, which it might be due. I kind of like to have him on after the FOMC announcements so we can kind of go back and see. Because, when we look at those FOMC announcements, and again, we're going to see it on the 27th of this month. Let me just show you here real quick. Here is the current rates, and it actually bumped up more today. So what we're seeing now is a 10% or 9.4% chance that you're going to see a full 1 point increase on the 27th, which is kind of insane, right? First, at the beginning of the year, it was, we might have 1 or 2 raises this year of 25 basis points. Then it was 50 basis points. Then it was 75 basis points. And now it's slowly creeping into the picture. Notice it's increased every day. It's getting more and more probable that you're going to see a 1% increase, albeit it's only 9.4%. You've got 90.6% right now. We're going to see 75 basis points. So I will probably try to hold off on having Bill until after that, just because I look at these rates and I formulate my hypothesis about what's going on with the Fed, the markets overall. But Bill has this amazing way of looking at stuff that I just don't. I understand it on a basic level, but not extremely in-depth. So I'll let him fill in the blanks. Usually, we focus on this one rate increase, but I think last time we had 5 specific rate increases, and 4 of those I was not really aware of, and maybe he'll enlighten us more on that going forward. Thanks, Lori and Lisa. Appreciate that. It's all good. We just love doing the show. If you guys like it, it's always encouraged to hit that thumb. If you don't like it, it's okay. If you don't like the show, I've actually encouraged people before. If you don't like it, then just email me and tell me why you didn't like it. What I hate is trolls. I used to get people give thumbs down. My guess it was probably Sam Seiden trolling me and putting a thumbs down or telling his little minions to hate on this show. it is what it is. You know, I got to hate on his stuff as well. All right, that's going to do it for me for today. It is our July 12th show, so tomorrow's going to be July 13th, which means Prime Day. I'm sure some of you just dumping money into Amazon today. I didn't even get to go look into the overall markets for everybody, but time is up. I'll have to do that one for tomorrow. So thanks, everybody. Hope you enjoyed that with Scott McCormick. Find out more information at tradingacademy.com about when and where to see Scott going forward. I'll try to bring him on again another month, and that does it. I will see you all tomorrow. Take care.